everybody, Chris here from Projectoption, and in this video we're going to cover a massive iron condor management study with over 71,000 trades in the results. So in this test we're going to go back 10 years in the S&P 500 ETF, and we're going to test 16 different iron condor management combinations, and we're going to see which ones are the most profitable for two iron condor variations, and then we're also going to look at how implied volatility at the time of trade entry impacted the performance of those trades. So there's a ton of content in this video, but I guarantee you that it will change the way you trade iron condors. Alright, so let's briefly discuss what we're testing and then let's get right into the results. So iron condors are extremely popular among options traders as they are market neutral trades that have limited loss potential and a high probability of profit. Now that's generally speaking, and it depends on how you actually structure the trade, but that's kind of the general trade characteristics of the iron condor. Now in this video, we're going to examine 10 years of iron condor management data from over 71,000 trades in the S&P 500 ETF. Now we're going to find out which strategies were the most profitable, which were the least profitable, and how implied volatility impacted the profitability of various management approaches. Now we're going to look at the S&P 500 ETF, which is the ticker symbol SPY, and we're going to look at the time frame between January 2007 and March 2017. Now that's the most recent standard expiration cycle as of this recording. Now the entry dates we're going to look at are every single trading day over that time period, and we're going to target the expiration cycles closest to 45 days to expiration with standard equity options. So we're not going to use any weeklies or any quarterlies. We're sticking to the standard cycles. Now since we're entering on every single trading day, that closest expiration cycle to 45 days is actually going to land anywhere between 30 to 60 days to expiration, since there's not a 45-day cycle on every single trading day. Now we're going to test two different iron condor variations. The first variation is to sell the 16 delta call and put and buy the 5 delta call and put. And the second variation is to sell the 30 delta call and put and buy the 16 delta call and put. So all metrics are going to be based on one iron condor position, so one contract for all of the options in the iron condor. So for each iron condor variation, we're going to test 16 different management combinations. So that's going to be take the profit or hold to expiration, or take the profit and exit at a 100%, 200%, or 300% loss level. Now as an example, let's look at the 50% profit target or 200% loss level and see how that trade would be managed. So let's say the entry credit is $1. A 50% profit would be 50 cents on a $1 credit, so we'll close the trade when the iron condor drops to 50 cents. Now the loss limit in this case would be $2. So since we collected $1 for the iron condor, a 200% loss would be 200% of the entry credit or $2. Now a $2 loss would occur when the iron condor trades to $3. So if you sell an iron condor for $1 and the trade reaches $2 or $3, you'll be down $2 on the trade or 200% of the entry credit. So that is how we calculated each of the management combinations, and that's how we managed each trade. So now let's get into all of the results. So let's go ahead and get started with the win rates for the 16 delta iron condors. Now I want to go through a couple examples to show you what the x-axis actually means so that you can read all of the rest of the graphs in this video. So the first number represents the profit target and the second number represents the loss limit. So anywhere that says exp, that means the trade was held to expiration as opposed to being managed for a profit or loss. So for example, 25%/exp means that the trades were held for the 25% profit target, or they were held to expiration if the profit target was not reached. Now for example, the 50%/-100% bar represents the 50% profit target or 100% loss limit combination. So the trade was either closed for a 50% profit target or a 100% loss limit, depending on which happened first. So as we can see here, closing profitable trades early results in a boost in the percentage of profitable trades, and taking losses actually reduces the profit percentages, but not by a substantial margin. So this is to be expected because when you close trades early for a profit or loss, that is going to change your win rate accordingly. Now let's go ahead and look at the average profit and loss of each management approach. So based on these bar graphs, we can see that holding to expiration actually had the highest average profitability per trade over this period of time. Now that doesn't necessarily mean that holding to expiration was the best approach, which we'll dive into a little bit deeper in a second, but as we can see here, holding to expiration had the highest average profit and loss, while managing profits earlier actually reduced profitability because we're taking smaller and smaller profits, but we're keeping the losses the same. So in this slide, we're looking at the average time in trades based on each management approach. So by closing trades earlier, each position is held for less time on average. Now, since we have less time in each trade, that means we can make more trades in each similar period of time. So for example, with the 25% profit target or expiration approach, each trade is held for 15 days on average. So that means for each 45-day window, we can have 3 of those trades on average. So knowing this, we have to adjust the average profitability per trade to some standardized time period so that we can adjust each trade's profitability to an equal period of time. So on the next slide, we're going to adjust the average P&L per trade to a 45-day time period based on the average time in each trade. So to adjust each trade to a 45-day window, we're going to take the average profit and loss per trade and multiply that by the 45-day period divided by the average time in trade. So let's say the average profit and loss for one approach is $10, and let's say the average time in trade is 15 days. So we would get an average P&L of $10 times 45 over 15, which would be $10 times 3, which would give us a 45-day adjusted P&L of $30 on average. So when we adjust each approach to a 45-day window, we actually see that holding to expiration is no longer the trade with the highest profit expectancy. Now, based on these values right here, we can see that the approaches with the highest expectancy for each 45-day period are the 50% and 75% profit target approaches. So the 50 to 75% profit target with either expiration or one of the 3 loss-taking approaches tend to stand out in terms of profit expectancy over a 45-day period. Now, of course, we do have to consider commissions since, if we make more trades in each 45-day period, that's going to rack up our commission costs, especially for a 4-leg option strategy like the Iron Condor. So let's go ahead and look at the commission-adjusted 45-day average P&L and see which approach stands out as the most profitable and the most viable when adjusting for commissions. So on this graph, we're looking at the 45-day average profit and loss per trade based on the figures from the previous slide, and we're subtracting out the estimated commissions for all of those trades over each 45-day period. So our estimated commissions are based on a $1 fee per option contract with no ticket charge. So that means to open an Iron Condor, you're going to pay $4 in commissions because you're going to pay $1 per option contract. And to close that trade, you're going to pay another $4. So in terms of round trip fees, we estimated it as $8 per round trip trade. Now, as we can see here, managing at 25% of maximum profit potential generates the highest number of trades and therefore the most commissions for each 45-day period. Now, as we can see here, that creates a substantial drag on the performance of the profitability of that approach. And as we can see here, the 50 to 75% profit-taking approaches stand out in terms of the 45-day average P&L expectancy when adjusted for commissions. So based on 40,000 trades of the 16 Delta short option and 5 Delta long option Iron Condor, we find that managing profits at 25% of the maximum profit potential has the highest success rate but the lowest profit expectancy when adjusted for commissions. So to make a long story short, for this particular Iron Condor variation, managing profits at 50% or 75% of the maximum profit potential while taking losses or holding to expiration had the highest profit expectancy over each 45-day period when adjusted for commissions. So now we're going to look at the 30 Delta short option and 16 Delta long option Iron Condor variation, and we're going to look at all the same metrics we did for the previous Iron Condor variation. Now you'll notice that we've taken out the 300% loss level as there were very few trades in which the loss was even that high. So since the loss potential wasn't that high, didn't make sense for us to keep that loss limit in there. So we only kept in the 100% and the 200% loss limit combinations. So overall, we have about 30,000 trades in all of the results. Now, as expected, managing profitable trades earlier resulted in higher success rates across the board, with the 25% profit target approaches having success rates over 80%. But what about the average profit and loss per trade? So interestingly, managing profits earlier for the 30 Delta Iron Condors actually increased the average profit and loss per trade, as holding longer resulted in more losing trades. So with the average P&L metrics calculated, let's actually go ahead and look at the average time in each trade for each approach, and then normalize the profitability to a 45-day window, and then subtract out commissions to determine which approach has the highest profit expectancy. So as we would expect, closing trades for profits or losses reduces the average time in each trade. So now that we have the average time in each trade for each approach, let's take the average profitability and normalize it to a 45-day window, and then subtract out commissions to determine the quote-unquote optimal management levels for the 30 Delta Iron Condors. So when we take the average profitability of each approach and we normalize it to a 45-day window based on the average time in each trade, we find that the 25% profit target approaches have the highest profit expectancy when normalized to a 45-day window. Now that's very interesting because if you recall, the 16 Delta Iron Condors had the highest profit expectancy in the 50% and 75% profit target categories. Now with the 30 Delta Iron Condor, the short strikes are much closer to at the money, and therefore we actually saw a notable increase in performance when taking profits earlier at the 25% profit target level. So this data suggests that based on the 70,000 trades that we've tested, managing profits earlier for trades with short options that are closer to at the money tends to be a better approach than managing profits at a higher percentage. So when we take out the estimated commissions for the 30 Delta Iron Condors over a 45-day period, we find that the 25% profit target category still is the best approach in terms of historical profitability levels. Now, even though the 25% profit target approaches have the highest number of occurrences, they have the highest average profitability, and therefore the commissions take up a lower percentage of the overall profits. So, despite having the most occurrences, the 30 Delta Iron Condors have historically performed best when taking profits at 25% of the maximum profit potential. So now that we've discussed the 16 Delta and 30 Delta Iron Condor performance with various management combinations, we need to look at the VIX level at the time of these trade entries to determine if implied volatility increases or decreases performance based on the management variations. So how did each Iron Condor management approach perform in various implied volatility environments? So to find out, we evenly divided all of the occurrences into 4 VIX buckets based on the VIX level at the time of trade entry. So for our cut points, we used the 25th percentile of VIX levels, the 50th percentile of VIX levels, and the 75th percentile of VIX levels to create 4 evenly divided buckets with an equal number of occurrences in each bucket. So the first one is VIX below 14, the second one is VIX between 14 and 17.5, the third bucket is VIX between 17.5 and 23.5, and the highest volatility environment is VIX above 23.5. So each of these 4 buckets has an equal number of trades, which allows for a very valid comparison of the trade performance in each volatility environment. So let's quickly go ahead and look at the 45-day adjusted P&L, less commissions for each of the Iron Condor variations when filtered by implied volatility at the time of trade entry. So here we're looking at all of the 16 management combinations for the 16 Delta Iron Condors, and we're looking at 4 VIX buckets based on the VIX at trade entry. So the bars are colored sequentially from the lowest VIX environment to the highest VIX environment, with the light colored bars being the low VIX entries and the dark bars being the high VIX entries. So in this graph, we're looking at the 45-day average P&L minus the estimated commissions for that 45-day time period for the 16 Delta Iron Condors. Now, after taking out commissions, we can see that the approaches with the highest profit expectancy are the high VIX entries with larger profit targets. So for example, if we look at the 25% profit target or expiration, we can see that the profit expectancy is actually positive in the first two VIX buckets, but when you go to the higher implied volatility entries, we actually have a negative profit expectancy based on the 25% profit approaches. Now, when we look at holding to expiration or managing at 50% or 75% of the maximum profit potential, we see that the highest profit expectancy lies in the high VIX entries. So this data suggests that when you sell the 16 Delta Iron Condors in the highest implied volatility environments, the highest profit expectancy lies with taking profits between 50% and 100% or holding to expiration, combined with some loss management strategy. So this is very eye-opening in that when you sell iron condors, selling iron condors in the highest VIX environment has the highest profit expectancy relative to selling iron condors in a lower implied volatility environment. So let's move on to the 30 Delta Iron Condor. So after taking out commissions, the highest profit expectancy for the 30 Delta Iron Condors resides in the high VIX entries, with many approaches having negative profit expectancy in the lower VIX entries. So this is very interesting and suggests that the 30 Delta Iron Condor, or selling an iron condor with short options that are closer to the current stock price, is a better strategy for very high implied volatility environments. Now, as we can see here, many of these approaches actually had negative profit expectancy when entered in the lower volatility environments. So between, with a VIX less than 23.5 in this case, a lot of the approaches had negative profit expectancy when taking the average profit and loss and adjusting it for commissions. So this basically says to us that if you're going to sell a 30 Delta Iron Condor or an Iron Condor with short options that are much closer to the current stock price, that trade might be better suited for high volatility environments. Now, of course, these are historical results and are not guaranteed to continue, but we have to work with what we have, and from this data, we find that the 30 Delta Iron Condor seems to be a high IV trade. Alright, so we've covered a ton of data in this video, and we've analyzed over 70,000 trades and all of the results that we've discussed. But let's quickly summarize the findings for the 16 Delta and 30 Delta Iron Condors. So first of all, for the 16 Delta Iron Condors, the best performing approaches have included taking profits at 50 to 100% of max profit in high VIX environments. So actually, when we're not accounting for VIX, the highest profit expectancy approaches when adjusted for commissions include taking profits at 50 to 75% of the maximum profit potential. Now, when we take into account the VIX level at the entry of these trades, we see that the high VIX entries have historically had the highest profit expectancy when adjusting for commissions. Now, when we move on to the 30 Delta Iron Condors, we see that the 30 Delta Iron Condors have typically performed best when entered in a high VIX environment. Now, when we don't account for the VIX at entry, we see that the highest profit expectancy lies in the 25% profit target approaches. Now, that's because the short options are much closer to at the money, and you're going to have to wait a lot longer to hit that 50% or 75% profit target, and waiting longer has historically resulted in a lot more losing trades, and we've actually had the most profit expectancy when taking profits at 25% of the maximum profit potential. Now, as we can see, and as we've discussed previously, the highest profit expectancy for the 30 Delta Iron Condors is when the VIX is at a high extreme, but in this case, the VIX being over 23.5 has resulted in the highest profit expectancy for the 30 Delta Iron Condors. So we've covered a ton of data in this video, and to be honest, we actually did not cover all of the metrics that we cover on our website. So if you're interested in seeing all of the results and all of the metrics we pulled for each Iron Condor management approach, you can go to our website, head to the blog, and look at the Iron Condor management study. So we've provided the link on this slide for you if you want to go ahead and type that link in, but otherwise we've included the link in the description as well. Thank you so much for watching this video, everybody. If you enjoyed this research, please go ahead and subscribe to our YouTube channel, as you'll get all of our future options trading research as we come out with it. If you want to check out some more of our research, go ahead and click on that playlist link on the right hand side. Thank you so much.